I'm really thrilled to have this panel here today with some former students and others in the sector. And we're gonna spend about 30-40 minutes. I've got some questions for them, a little bit of a discussion here at the panel, and then just open up to questions from all of you. I know there's many questions out in the audience. Before we get started, though, I'd like each panelist just go in order. Then just give 30 seconds on your firm. What it is you do in relation to climate tech investing? So, Eliza, you want to go first?
People hear me? Is this working?
Oh, yeah.
Okay. So I'm a partner at Congruent Ventures. We're a Bay Area kind of SF-based early stage climate tech firm. So we do VC investments into all things climate tech. So if you look at our website, we've tried to bucket that into kind of 4 categories that it really touches anything with a climate or sustainability angle. Our core strategy is pre-seed and seed investing. We typically lead and co-lead rounds. And then we also have a secondary fund that's focused on growth investments into our portfolio, which will kind of connect to some of the questions that Professor Usher will get into later about kind of the missing middle. My role on the team is I split my time between those 2 funds. So my background is in later stage investing. So I was brought onto the team to help deploy our growth fund, but have started also doing early stage deals because I exist. So I kind of get to do both. That's Congruent. Happy to connect and share more after as well.
Thanks, Liz. Amanda.
Hi, everyone. I'm Amanda, and I am a principal with Blackhorn Ventures. We are a Denver-based venture fund investing at the seed and Series A stages, really with a focus on industrial tech and industrial decarbonization. So for us, that translates to companies primarily in the energy, manufacturing, built environment, and transportation and logistics sectors. And we're typically investing in technology solutions that are capital efficient, often software enabled, but looking to really kind of transform these legacy industrial sectors to be much more resource efficient across the board. And I will kind of pause there.
Okay. Thank you for the introduction. Daniel, over to you.
Thanks, Bruce. So let me just start with a thank you, first of all. I may not have the both bodies of Eliza as an alum of CBS, but I do consider myself, in some ways, a Columbia baby. My parents met at graduate school in Columbia.
It never happened here.
So I don't know if any of that stuff is going around at CBS, but I might not exist in this world if it wasn't for this educational institution. Anyway, and I also wanted to thank, in addition to you, Bruce, for the work that you're doing with teaching, the student group, Tarushi and Stephanie, who helped organize this panel. Hats off to you. It is actually really exciting to see this many faces and engaged young people who, in this moment, which we'll probably get into in a minute on the panel, one might argue a challenged moment in some ways for climate finance in the world and in the United States, and to see this many talented young people who are focused on this area, it's actually really energizing. So thank you for being here. The Angeleno Group story. So Daniel Weiss, co-founder and managing partner of Angeleno Group. We're a Los Angeles-based venture capital and growth equity firm dedicated exclusively to clean energy and climate solutions investing. I co-founded the firm with my partners in 2001. We do late-stage venture and growth investing primarily. We've led or co-led a little over $3 billion of investments into the space, inception to date. We're currently investing out of our 4th flagship growth equity fund, Angeleno 4 LP, that closed in December of last year. Looking forward to the conversation.
Terrific. And one of the beautiful things about New York Climate Week is it draws people from across the country and across the world. We got San Francisco, Denver, LA-based investors. City is full of folks coming in to talk about climate change. So let's start with the elephant in the room, which is President Trump, the OBBB, and the impact on your sector, your investments. Maybe start with impact on portfolio, and maybe Eliza, you go first, and just on sentiment and how you're all thinking about what's happening.
Yeah, this is a big one. I can start and then you two can fill in. So I think the worst part about the admin shift was not actually like the specific policy, but just the level of uncertainty that it brought to founders in our portfolio and kind of how to push their businesses forward. And we invest in hardware and software. So most of our companies who are kind of building physical things just kind of hit a roadblock of like, am I still going to have access to this funding? What's going to happen to my sector? So it was really the uncertainty that kind of spooked us the most, I would say. I think fast forward to kind of OB3, kind of what we're calling it, passing. I think our kind of punchline is that it could have actually been worse. So we obviously aren't thrilled with some of the clean energy tax credit rollback that will be happening over the next 5 to 7 years. But we think that all in all, from the original reconciliation, like there could have been a much worse outcome. So we, I think you mentioned at the beginning, as venture investors, we have to remain somewhat optimistic or our jobs would be very difficult. I think there are certain sectors that, are better positioned than others. So geothermal, nuclear, batteries, alternative fuels, these are all things that we're currently invested in and that we'll continue to invest in, that may have been slightly impacted, but we still feel have kind of bipartisan support, which will be really helpful for deployment. I can pause there. And I guess actually one last thing on the portfolio side. So we're a traditional fund with traditional LPs. So this is obviously super top of mind. And we kind of went through a whole portfolio review, and the net takeaway was that our portfolio is pretty neutral when it comes to the actual policy impact. None of our companies had actually received IRA funding. We typically don't invest on that type of kind of incentive coming in. We look for strong unit economics and strong teams to go deploy the best technologies and disrupt sectors. So our view is the portfolio is kind of neutral. There's some companies that are more impacted than others, but at the end of the day, we're backing entrepreneurs who are super steadfast in solving these problems. So they're going to adapt, no matter what the policy landscape is.
Thank you. Amanda, thoughts on this?
Yeah, I'll just add a couple of quick points. I'd say the net impact was similar for us when we did a portfolio review. A couple of companies, especially those that have hardware components and were getting some of the clean energy tax credits, were impacted by it. But on the flip side, I'll mention two bright spots of where companies are actually seeing some tailwinds from the policy, and that's incentives around grid modernization, which continues to be a strong need, as I'm sure everybody is very well aware, as well as more incentives for manufacturing modernization and solutions that can really make better use of existing assets, especially within the United States. So one of the things we're seeing is, while there is a push to reshore manufacturing to the US, that is obviously going to take a really long time to actually build out new facilities. And so some of the companies in our portfolio that are helping to optimize existing assets and existing facilities are seeing quite a few tailwinds from the policy side.
Daniel, thoughts on the policy change?
Yeah, well, I would echo both some of what Eliza and Amanda have said. I mean, no question, it's been a rough several months, starting with the withdrawal from the announced withdrawal of the Paris Climate Agreement, which I think doesn't actually go into effect until January of next year, and then going into countless executive orders, and then the OBBB, and then even more recently, the announcement of examining endangerment findings around GHG. It's a steady drumbeat of challenging news from the nation's capital. On the other hand, as Eliza pointed out, a lot of the elements that were most feared in terms of the overturning of the Inflation Reduction Act didn't come to pass. In fact, I was dorking out over a cup of coffee this morning at the hotel before starting the day by reading analyst reports of some publicly traded companies that touch the energy transition. And I was reading a JP Morgan analyst report on a publicly traded company called Quanta Energy Services, which is an EPC firm based in Houston, Texas, that builds a lot of infrastructure connected with energy transition. And their CFO was quoted as saying that one of the catalysts, one of the reasons to be optimistic about the stock is that they've got 5 years of certainty in their window now. even in this current environment. And so I totally agree that there still are some catalysts in place. And then I would also agree with Amanda that, there's an ecosystem of companies, particularly private companies, that are offering economic value propositions to their customers independent of regulatory drivers. And we can get into some of the examples of that. But in our portfolio, and it's just one small example, and we've made 5 investments out of the new fund. We're about to hopefully announce our 6th. But each of those companies, we think, is on track to hit their financial forecasts for 2025, even in this environment. And when you zoom out back to the public markets as a proxy for what's happening in capital markets, sometimes, capital markets behave in counterintuitive ways, but there are insights there. So the S&P Clean Energy Index, YTD, in the drill baby drill era, is up north of 20%, whereas the conventional S&P Energy Index is actually down year to date. So it gives you sort of, there's some signals. You don't want to overread into some of those things, but yeah, there's a lot of reasons for optimism. And even though venture will be down YOY, probably from 24 to 25, and was down from 23 to 24, there's still a lot more venture dollars flowing into this space than there were 10 years ago.
And that's an important point. You mentioned historic, as professor, you put things in historic context. If we were here 3 years ago, 2022, people were feeling pretty good about climate investing, climate tech before the IRA. And the IRA was a fluke. Actually, most people in the industry did not expect it to happen. It was a fluke with then Senator Manchin and so on. And that just supercharged everything. Really what the
OB3.
OB3, not O3B, whatever. It kind of just rolls us back to much of where we were in 2022 in terms of policy, except many of the industries now have a lot more momentum, a lot more acceleration. The key point here is there's now at least some policy certainty there wasn't for the last 8 months. And that caused a lot of problems for investors. We are where we are. Dealing with that. So let's move on from the policy issue into the opportunity issue, which is what venture capitalists, of course, focus on. Amanda, maybe you could go first, because one of the other big hot topics here on the campus, of course, is AI and robotics and issues like this. How do you think about the potential opportunity and risks around physical AI solutions, things like automation, robotics, when it comes to climate tech? What are your thoughts? That's something you guys look at.
Yeah, we spend a lot of time thinking about, of course, AI, because it is a generational shift in technology, and it will impact every sector. But in particular, given the focus that we have on more industrial applications, we think a lot about physical AI. So I'm sure all of you are aware, but really this comes into play when you start to combine sensors, so the ability to perceive the real world, layer that into intelligence, and then apply it into actuators or kind of robotics, real physical world. And so when we think about AI more broadly, I'd say AI today is really good at content generation. So we're starting to see this, and everybody can interact with it in things like ChatGPT. A lot of the models, the LLMs, are kind of built currently with linguistic reasoning as kind of the foundation. When you start to look at physical AI, the foundation model itself is different. So the models are really built using physics, using spatial reasoning. And so when we start to think about, what does this mean from an investment perspective over the next few years, we think today, 2025 was kind of the year of agents. We saw AI agents really explode across the industry, but many of them are not reliable yet. So when we are looking at kind of enterprise solutions, they're all, human in the workflow to really inform the models themselves. We think when you start to look at 2026, 2027, as these models get more specific context and layer in more data around specific use cases, we think that you'll then start to open up the door for physical AI. and for AI to start to have decision making and really apply that to physical objects. So whether it's robotics, which is kind of the easiest example to think through, but physical AI for the sectors that we're investing in have a huge shift. So within the energy space, for example, we are already investing in startups that are using that physics-informed AI to build out digital twins of the grid, really be able to see what is going on live, begin to streamline the planning process, the interconnection process, and then eventually operations itself in the control room. So that's one application of taking AI into a very specific use case and layering in physics-informed AI to make it useful. We're seeing a lot of similar applications across manufacturing, where manufacturing and utilities are facing these kind of structural labor shortages. And so especially when you look at some of the most dangerous jobs across these sectors, we're seeing a lot of opportunity over the next several years to begin to combine AI and automation into really powerful solutions that are going to, we think, transform manufacturing, construction. There's a lot of use cases you can start to see come to life. And for us, the last point I'll say is, from an impact perspective, we are tracking, emissions reduction, resource efficiency, of course. We also have a layer of workforce enablement as part of our impact mandate. And that's really because we just feel that for this transition to be successful, there's a lot that needs to happen to empower the workforce as well. And so when we look at different solutions around job safety, job quality, upskilling, we think some of these technologies are really relevant, especially for these industries that have these structural labor shortages, often because they're really hard jobs. And so improving jobs for people while using this technology to kind of enable that.
Good. Thank you for that. Bringing those two macro trends that we look at Columbia together, AI and climate. Eliza, back to you for a sec. What's investment perspective? What do you think is overhyped at the moment in terms of opportunities, and what's maybe underappreciated?
Yeah, I think so. Kind of staying on the AI topic, I wouldn't say it's overhyped. Obviously, like you said, a generational trend, and there's going to be a lot of tens of billions of dollars worth of value created in some of these AI companies. I think it's harder to find differentiation in some cases if it's just an AI wrapper trying to solve grid optimization. Like there's a lot of companies out there that are doing those things, so it makes it harder for us to go find the ones that are going to take market share and actually kind of build a moat. I would say where I'm most excited, or kind of where I think a lot of kind of value will be created, is actually in kind of the hardware that will enable the rapid proliferation of AI. If you think about kind of hyperscalers and data center power demand, we can't have any of the AI tools and softwares that you mentioned without advanced data center technology, speed to power, which is clean, firm power, getting clean energy onto the grid by the end of this decade in a big way, which in some cases also commands a price premium, which is something that you mentioned. Advanced kind of power electronics, transformers, cooling technologies, all these things that will make AI possible. So we do both. I think it's kind of a double-edged sword. We invest in kind of the software and AI-enabled tools that can actually help people solve climate change faster, but we also invest in the kind of hardware that makes it possible.
They're called picks and shovels of the gold rush. Yeah. Daniel, taking the lens back a little bit, bigger picture. I know you're optimistic about decarbonization. Why? What gives you reason for optimism? What are you positive about in terms of technologies or industry?
Well, forgive me, because this may come off as terribly tone deaf, but in the spirit of trying to answer your question directly, I'll take a whack at it. Maybe we're investors, right? So we're thinking through the lens of folks who deploy capital. Maybe three reasons for some optimism: deal flow, valuations, and global secular trends. Deal flow. So We just acknowledge the fact that funding, across the board, certainly in VC, in climate tech, will likely be down in 2025 from 2024. And it was down in 2024 from 2023. But again, to your point about zooming out, what's less discussed, certainly in this historical moment, is the fact that there was a massive super cycle of unprecedented, of climate tech VC. It started in and around, it was a decade, 2013 or so, to 2023. We went from $2 billion a year globally in climate tech VC to $50 billion, 25x growth over a 10-year period. Why is that relevant for now in 2025? Because the seeds of innovation were planted in a garden around climate tech VC. And ironically, some of those seeds are growing in the very moment when this sector is profoundly out of favor. So last year in 2024, and we're on pace to hit these numbers, I think this year, the quality and quantity of deal flow that we're seeing at our little boutique firm in LA is better than it's ever been in our 20+ year history of investing in the sector. And so we are, Eliza and Amanda can comment on their deal flow. We are seeing extraordinary deal flow. And when you're an investor, the landscape of investable opportunity is critical, right? Deal flow is like oxygen. The second factor is valuations. So again, back to public markets, it's a little fuzzier in private markets, but public markets is a proxy. Notwithstanding the year-to-date numbers as of September, but shortly after the inauguration and the new administration coming in, at the end of Q1, just to give you a sense, the public markets from the recent high water marks in this space 4 years ago during the pandemic and SPAC mania in this space, public markets were down 70%. And private markets, as you all probably know, tend to lag public markets. So deal flow is up, valuations are coming down. We're seeing not just valuations coming down, and we can wonk out and get into term sheets and deal structures if folks are interested, but I'd be curious what you two are seeing. We're seeing terms in convertible preferred securities we absolutely couldn't get 12 months ago. So deal flow is up, valuations are down, and we believe that global secular tailwinds are intact. So notwithstanding the fact, for example, that the largest economy in the world is about to pull out of the Paris Climate Agreement. I think you'd know better. We've got a brilliant professor with us. I think, what is it, US GDP as a percent of global GDP, something like 24% or something like that?
I don't know.
Okay. So
But I guess more like 30, but anyhow, close.
okay. But so 70 to 75%, even after we pull out of the out of the Paris Climate Agreement, the vast majority of global GDP is still signed up to net zero pledges by 2050. So when you pull out from the near term and the domestic to the long term and the global, many of the secular tailwinds that are driving decarbonization and energy transition are intact. So yeah, those are three thoughts: deal flow, valuations, and secular tailwinds.
Let's go back to Amanda and Eliza on this valuation issue. And as an investor, in some ways I feel better now than it did 2 years ago, because my understanding from the investors I've dealt with, 2 years ago, it sounded like a great time to be investing in climate tech, but actually valuations were crazy. It was really hard to get into deals. There was so much competition. How does it feel now in that sense?
I joined Congruent as the valuations were kind of coming down. So I saw like the correction happening with companies that probably raised at valuations that were much too rich for kind of where they were from a fundamental perspective. And so what happens in that in reality is like those get corrected when you go out and you can't raise and attract new capital because the valuation of the pref stack is too high. And what that looks like is it could be a recap where you kind of bring that down, you right size the valuation to meet where the company is. And you've seen that across the board with a lot of companies in this like Series A, Series B range. I think to your point, when you're in an environment like that, there's a reversion to the founders who deserve to earn capital when it's harder to get. And I think that's a really key point. And so I think, deal quality at that stage goes up because like founders that can't attract capital in a harder fundraising environment kind of float away or go do something else. And so the founders that stick around and kind of weather through that, I think are worth investing in. At the seed stage, that's kind of A and beyond. I would say pre-seed and seed, which is where we write our entry checks. There was kind of a trend where when the sector was very hot, a lot of kind of generous investors came in and were, outbidding us on every deal. It would be, 50 million plus post money for a company with like a founder and an idea, which for us is like very difficult because we invest for ownership. So we're targeting 15 to 20% on our first check in. And so you can do the math that doesn't really work out for us with our, our check size of 2 to 3 million. I think, we try to stay very disciplined there and some funds do, some funds don't. I think you've seen a lot of those kind of climate travelers, as like a lot of the clean tech 1.0 folks call them, have kind of exited again. And so there's been at the seed as well, kind of a reversion to normal pricing mechanisms.
Yeah, I would just add, some of the banks have great charts on this, but if you look at valuations across early stages, there's really fat tails now. So the idea of like the average valuation is a little less relevant because there's such fat tails. So we're definitely seeing that flight to quality like you were referencing, but there's not as obvious of this is the metric you need to hit X stage at X valuation. Like it's much more fluid than that. And I think that's why you're seeing some of this, for companies that appear really strong and are having really fast growth, you'll still see really high valuations. So I think that definitely resonates for us. And then the other point I'll make just from the investor perspective, and you kind of hit on this when you talk about deal flow, combining valuations, but we continue to see from some of the market